This client right here has a student loan. Uh, when they first got with me, they had a student loan for $70,961.70 with a 5.62 interest rate, and the life of the loan was 14 years. So when my client had got with me, we set up a line of credit for $7,000, and the interest rate on that line of credit was 16%. In about 5 or 6 months, she'll be able to go uh, get a get an increase on line of credits. That's one good thing about lines of credits is you can get an increase after a certain amount of months when you show consistency and on a month in month out basis. So with this client, the income is $6,350. The expenses is $3,385. The cash flow is very healthy with a $2,965 cash flow. Remember, if cash flow is negative, this plan does not work. So we need our clients to be in the positive cash flow in order for this plan to work, in order for you to get to your financial freedom, pay off all your debts, etc. Okay, so in this case, I'm teaching my client the plan that we went with was chunk payments towards the principal of the loan, and that's what we're doing. And the plan is being executed perfectly right now. So I'm breaking down how it all works with the chunking of payments towards the principal of the loan to pay down the loan in a fashionable time frame instead of a 14-year time frame, which is going to cost you a lot of money in interest. So my job is to save you money in interest, to put money back in your pocket. So with that being said, we already imagine that the the client has already paid $7,000 towards the principal of the line of credit. I mean, the principal of the loan, right? So what they do is they call up the bank or whoever the institution is for that line of credit. I mean, for that loan. Sorry. And so we call them up and we be like, we want to put a $7,000 payment towards the principal of the loan. So now that we done that now it's time to pay down, right? It's time to pay that $7,000 down to a low balance to reuse it again, to reuse the line of credit again to make another payment. So the first thing we do is we put our income inside of the line of credit. I know a lot of you guys be like, but I'm putting my whole check inside the line of credit. Like I don't get it. Understand, when you put your income inside of the line of credit, you just created that much more space to use your line of credit. And that's why we always say your expenses can't be more than your income, because now that you don't put your income inside of the line of credit, right? Now you have to pull $3,385 out for your expenses for the month, because you got to pay all your utilities, you got to pay your phone bill, you got to pay car insurance, you got to pay all of that stuff, right? So you're pulling that same money out to pay for your expenses. So that's why I say this is why the line of credit is so powerful, because you can take money, put money in, and you can take money out in the same manner. No fees, no transfer fees, none of that. Some places does, but most places that you go to, they do not. So try to go to the place that do not incur transfer fees when you're transferring money in and taking money out. Okay, so yeah, so like this client, they put their 6350 inside, right? And the balance came down to $650. But by the end of the month, or the beginning, the end of the month, middle of the month, whatever the case may be, in month number one, they have to pull their expenses out, and their expenses is $33.85. So you got to add, right? You have to add because it's adding to the line of credit. So you put the $33.85 in, and it goes, now it's up to $4,035, right? So we have to pay interest now. Remember what I said in the last video. Interest is already included. Soon as you put your income in, you have already satisfied the interest payment. But for this example's sake, I'm putting the calculated interest in this example just to show you what your interest payment will look like. So in this case, this client interest payment is $30.80, right? So with that being said, the way that you calculate your interest payment, remember, it's an average daily balance. So we basically get this number, 4,035, and we get the 650, right? And we put them together, we put those numbers together, divide it, and do some more calculations, and that's how we end up with the $30.80. So that is the payment for month number one of your interest payment. Because this person got a good, nice, healthy income coming in and got a nice, healthy cash flow, this client is able to pay down on $7,000 pretty quickly. If you notice, this client has already paid the $7,000 of what they used towards the loan. They have already paid it off in month number two. So after you add the interest to the final balance of 4,035, you get 4,065. Now, right, you have your income. Now it's month number two. You put your income in. But in this case, you don't have to put the whole income in. You just put exactly what's needed for the remaining balance, which is $4,065.80. Now your balance is at zero. Now that 7,000 that you just used, it has reloaded. It has reloaded and it's back to 7,000 again. So what we do is we call the institution that has the loan. We call them and we make another $7,000 chunk towards the loan, the student loan, to pay it down. Every time you make a chunk towards the principal of the student loan, in this case, it's the student loan. Every time you make a chunk payment towards that loan, you're skipping payments. You're skipping payments, making chunks, right? Which helps you not pay so much money in interest. We all know that you're going to pay some type of interest, but the whole thing is not overpaying on interest, and that's what we have been doing as people, is overpaying on interest. And so every time my client make a $7,000 chunk towards the loan, they are skipping massive payments. They will be paying on a month-to-month basis, but they are avoiding that now, which is perfect. That's what we want, right? We winning now. So like I said, we repeat. So guess what? After every 2 months, my client repeats the cycle that they just did. So every 2 months, we make a $7,000 chunk payment towards the student loan. So imagine every 2 months, it goes from 70,961. Now is at 63,961. And then after that, is at 56,961. After that is at, I think it's 40, 49, 961, right? And then after that, right, is at, you're at 42, 961. After that, and it goes on. You're at 35, 961, 70 cents. And then it just keep going. So every 2 months, you're making a chunk payment towards the principal of the student loan, and it's knocking down your overall debt that you borrowed on this loan. So that's the power in the line of credit, because now you're skipping payments by 7. Download your car's mortgage calculator and see if I'm lying, and just do what I just did. Just look at on the car's mortgage calculator. You can just see it. You can see the payments that you're skipping when you make chunk payments towards any loan that you have, whether if it's a car loan, student loan, a mortgage, any of those type of loans. You will see, because you got to understand, this student loan is on an amortized schedule, so it's at a fixed rate, right? This student loan payment is at a $620 and like some change, So when this, every time that we skip payments, we're putting this back inside of our cash flow. We're putting $620 back inside of our cash flow when we skip the advertising schedule. When we skip payments, it's allowing us to put money back in our pocket. We call that non-monetary. Like, monetary is money that you basically can see. Non-monetary is money that you don't see, but you're actually saving. So you will see it, you will feel it over time, but at the moment you don't see it because you don't actually see the money going back in your pocket, but you will feel it over time. So that's non-monetary. So, like I said, once my client does this process and repeats it over and over and over until this number goes to 0, right? So every 2 months, we're making $7,000 chunk payments, right? And this is your average daily. Remember, this is your average daily balance interest rate payment, right? So we're paying a little payment of interest to get this done. Now, moving forward, when my client successfully fulfills this plan and we go through with the strategy, my client would have paid off this $70,961.70 loan in 24.31 months, which is equivalent to 2 years and a little change. 2 years and a little change. So what would you rather do? Would you rather do 14 years and pay on it for 14 years, or would you pay on it for 2 years or 24 months? Common sense. I'll let you decide that. Now, to get deeper into the details of this, the line of for the line of credit, using this plan with the line of credit, making chunk payments of $7,000 every 2 months with this client, for her scenario, she will be when the loan is fully paid for in full, she would have only spent $1,118.26 on the whole ordeal of paying off the $70,000 for the loan. She would have only paid $1,118.26, right? Like, that's important. Now, let's say that she never used the line of credit. She never used it, and she would have did the whole 14 years. She did the whole 14 years, right? Say if she would have did the whole 14 years not using the line of credit and would have just paid and just would have just went out all the way to the end of the 14 years of the loan, this is the amount that she would have paid. For the student loan, just in interest alone, just in total interest alone, she would have paid $31,697.62. That's just complete robbery. And a lot of you guys right now are on this program. You're getting robbed in interest. You're getting completely robbed in interest. Completely. It's not even fair. You might as well go outside right now. Go outside and open up a Gucci duffel bag and just throw the money in the street. That's what you should do. You should just go down the road to your nearest local busiest highway, right? Let down the windows and just throw money out the window. That's what you should do, because that's exactly what you're doing in this case right here. Now, on this $70,000 loan, this $70,000 student loan, on it, right? The total payments that you would have paid in 14 years, you would have totaled out to be, it would total out to be $102,659.32. You just paid $102,000 on a $70,000 loan. You paid more for the life of the loan than actually what you borrowed. Come on, guys. Come on. But with a line of credit, making $7,000 chunk payments, guess how much I'm saving you? I'm saving you $30,579.30 by going with a line of credit. If you subtract the loan interest, total interest, with the line of credit total interest, this is the number that you get. If you subtract 2 years from 14 years, this is the saved time you get. You have saved 12 years of heartache and pain, and you have saved $30,000, right? Basically, you have saved $30,000, however you want to look at it, $30,579.30. You have just saved that in your pocket. Imagine what you can do with $30,000. Imagine what you can do with $30,000. You can go on vacation. You can take your kids to places that you really want to take them. If you don't have kids, you can just use it for vacation time. You can travel. You can go out to dinner. You know, you can do a multitude of things with an extra $30,000. You can invest in real estate, right? You can buy a property. You might can put a down payment on a property, right? Right? You can acquire so much with an extra $30,000 that's in your pockets. That's how much you would save with a line of credit. And that is the key. That is the key to a line of credit and the power of a line of credit and what a line of credit can do, opposed to what a loan is doing. A loan is literally sucking the life out of you. It's taking your whole soul, right? Right, if it's a student loan, an auto loan, a mortgage, a loan is a loan. They're putting you on an amortized schedule. That's why that's why they're stealing money from you, because you're doing it on an amortized schedule, right? You're doing it on an amortized schedule, and you're losing money instead of saving money, right? And in the process of all of this stuff, you still with a line of credit, making it $7,000 chunks every 2 months. Guess what you're doing? Also, you're also building your credit. You might gain an extra 25 to 50 points by using this system for this scenario alone. I had one client, they credit score increased by 100 points. One of my clients went from 570 to 670 in a matter of months. I'm not talking about years. I'm talking about months. 6 months, 5 months. Credit score went up 100 points. That's how powerful a line of credit is. Your credit score skyrockets because credit bureaus only sees consistency. They don't care about how much you pay down. They care about consistency. And a line of credit keeps you consistent. With a loan, you're just losing money. You're just throwing money out the window. So keep that in mind. And guess what? Right? We want to, this is a 16% interest rate. This is a 5.62 interest rate. And you're paying more on a 5.62 interest rate than on a 16% interest rate. I told you guys, don't let the optics fool you. Just because you see 5.62 and you see 16, this doesn't make it better. Because these are two different systems. This is a loan system. This is a line of credit system. That's why I always tell you guys, educate yourself. Educate yourself. Educate yourself. Educate yourself. Please. Just because you see 16%, that does not make that less of power than get a loan. From what you see, this is worse. They setting you up for 14 years, man. Come on. We have to be smarter. So at the end of the day, this is the main thing. The main thing is we're just moving your income from one place to another, right? It's like going from a Toyota to a Lamborghini. It's like going from a Honda, right, to a Range Rover. And in the example of speed, right? So guys, listen. That's all you have to do is listen. Listening is a skill. My coach always said that when I play football. Listening is a skill. Listening is fundamental. Look at these videos. Look at these videos and just let it sink in. Right? Don't get carried away of trying to live a fake lifestyle that you're trying to portray to others. It's not about that. Right? Know your numbers. Know what your income is. Know what your expenses are. Right? Know those things so that you can really move forward in life, and so you can really build credit, and so you can really eliminate your debt, and so you can really acquire real, true financial freedom. It's a lot of people that can do a lot with $30,000 right now. So keep that in mind. And you're one of those folks. So don't be coming around here walking around with all this pride and with your chest puffed up, thinking that you got it all together, when internally you're really drowning in debt. You're really drowning in debt and you don't got it all together. And it's okay. I'm here to tell you that it's okay. But at some point you have to look yourself in the mirror and be a woman enough or a man enough to say, I got to do better. And then that's when you're truly gonna take the right steps to doing the right things, right? So we're moving your income from traditional banking and we putting it in tempo banking, right? A lot of people call it velocity banking. It's tempo banking, right? It's tempo, right? We're just putting it in one vehicle and moving it to another vehicle to pay off your debt and to save money. And when you save money, what you do, you get richer. All the wealthy people are doing this. You should too. The opportunity is here. You're not as bad as you think you are. You don't have the problem. We obviously know that these loan systems, these institutions, they are the problem, not you. You think that you a spendaholic and you think that you just a bad person. You're not, right? Visit my website, www. Um, uh, sorry, sorry, just had a brain fart. www.tempofinance.org. Sorry about that. And go on the website and schedule a call with us so that we can help you acquire true financial freedom. So we can build a plan for you, right? So that's all I have for you today. Stay blessed and have a wonderful day.